Super, thank you very, very much. As mentioned, the topic of this panel is alternative finance and funding for FinTechs, and actually the strapline of the panel is, they say you choose your investor like you choose your spouse, which I think for most of us, that will cast our minds to the seriousness of the funding decision and how much gravity we need to put on that, although for some, I suppose our minds might go to the idea of sort of swiping left, swiping right, possibly. But in any case, we're going to talk through many of the kind of relevant issues on the topic of funding this afternoon, and I'd like to welcome to the stage our fantastic panel. Thank you very much for joining me. I think before we kick off with introductions from the panel, I'd just like to highlight a few of the kind of really interesting data points referenced by Innovate Finance on their recent research on funding of the fintech market. Innovate Finance found that VC investment in UK fintech in 2017 saw a 153% year-on-year increase with $1.8 billion of investment across 224 deals. The UK ranked second globally in terms of both the capital invested and the volume of deals after only the US. And 2 UK companies ranked in the top 20 deals globally with rounds over $200 million. They were TransferWise, $280 million, and the Oak North round of $203 million. So I think a really impressive kind of track record last year, and one that gives us plenty of food for thought for this panel. But if the panel would please introduce themselves.
Hi, so I'm Anthony Craufurd. I work at Visa. I look after our venture program here in Europe. We're part of a global program who invests Visa's money in startups, typically a little bit later stage, growth stage, BC rounds, looking for where we as a strategic investor can add more than just cash to that startup's balance.
Super, thank you.
Good afternoon, I'm Catherine Lewis. I'm CEO of British Business Investments. That's the commercial arm of British Business Bank, which is the UK national development bank set up around 3 years ago now to improve finance markets for SMEs. We have a range of programs on the debt and equity side, trying to fill some market gaps that we've identified, but we're investing on a purely commercial basis alongside private sector investors, and we operate as a fund-of-fund model, so we select finance providers, we provide capital to them, and they in turn provide capital to underlying SMEs.
Yeah, good afternoon, everyone. I'm Christian Faes, co-founder and CEO of a business called LendInvest. We are one of the largest non-bank mortgage lenders in the UK, and we're an online marketplace for property finance. On the borrower side, we're very focused on the specialist mortgage market. So the core products are short-term mortgages, development finance, and then most recently buy-to-let. And then on the investor side, it's a very wide, diversified group of investors from small retail investors through to large institutions, banks and pension funds and so on.
Rob?
I'm Rob Moffat. I'm one of the partners at Balderton Capital. We're the leading Series A focused venture firm in Europe who are 100% focused on fantastic European companies with massive global ambition. I focus on FinTech at Balderton and work with a number of our FinTech investments, including Revolut, who I think spoke earlier, Nutmeg, Go Cardless, Zopa, Crowdfunding, Prodigy Finance, also on the insurance side, Zego and Dingy.
Hi everyone, I'm Tara. I'm a partner at LocalGlobe, which invests at seed stage, so the stage before Balderton would come in. LocalGlobe focuses on primarily UK-based businesses, although ones that have global ambitions, and has made a number of fintech investments. So Zego in common with Balderton, Trussell, Clio, Tide Bank, Bricklane.com, and I personally started my career at Aon in their M&A department and then at Wachovia, again in their insurance services department, so have spent a lot of time looking at insurtech and financial services. From my time at Wonga.com, have an understanding of that. I'm also the co-founder of Torre.com, which is a peer-to-peer car sharing service.
Super, thank you, Tara. And sorry, I should have warned you, before we get into the discussion, we'd really love to test the technology and engage you as the audience in the discussion a little bit as well. So we have a couple of interactive questions available through the IFGS app. The first of those questions, hopefully if you log into the app and find the relevant section, you'll see this question. As a business, are you looking to raise funds in the next 12 months? And I think this will really help the panels to frame their comments. around topics that are relevant to you as an audience. So it would be wonderful if you would try and log into the app and kind of cast some votes on this question, please.
2 responses.
I've got 4.
May continue moving, but it's kind of in that. I'm not sure it's statistically significant, but possibly more not than not. But then we have another question as well, a bit more of an adventurous one this time. I'd love to ask, are you considering an ICO, or would you consider one in the foreseeable future? Slightly more, something more exotic for a kind of last panel of the day. At least some of the audience are considering an ICO for sure. So, well, that's obviously a tremendously interesting trend, and one we'll touch on as part of the panel. I wonder, Anthony, if we could start with you though, since you're sitting here next to me. You lead Visa's venture program in Europe, partnering and investing in startup businesses. But how does Visa horizon scan across the amazing set of businesses that are out there today, find the most relevant trends, the most exciting trends for you, and then how does an engagement with a business typically work once you've found them?
Cool. Yeah, so as a strategic investor, right, we have 2 big drivers. One, we have to make a pile of money for the CFO. If he's going to let us invest in this, he wants to see a return on that capital still. So it's not just we want to burn the money. But the second one is more important. It's what's the strategic value will drive to Visa, and how will that have a double effect on us? So we're a network business. We're all about payment volume and growing that network. And so a lot of our theory is, where are we seeing people who can give us unnatural growth and be above and beyond what we're doing already, and that organic growth we're seeing. So there's very specific stuff. We'll look at theory, we'll look into one area and see what are startups doing in one specific area. So stuff we've seen in kind of machine learning, for example, for fraud detection and managing that. How does that impact Visa? What's the theory we should build, and where would we like to invest on that? The most recent one we invested in a couple of weeks ago was Solaris Bank. So they are banking as a platform. They make it much easier for new startups to get into becoming a regulated financial service. Just 5 APIs to issue cards, open bank accounts. Means that there'll be a wealth of new startups who can issue Visa cards in the future using that platform. Yeah. So find people like that, figure out what the commercial model which will make the most sense for them, and figure out where equity makes sense in that. And a lot of the time, actually, the best deal we can do is we just do a commercial deal and we don't have to take equity at all, because that's even cheaper. And the CFO likes it when we don't spend money, funnily enough.
Fair enough. And I think on Solaris still, you invested alongside others as part of a broader round. What do you typically look for when you're working alongside other funding providers, investments? Are there kind of particular preferences you have, or are there some kind of red lines that you wouldn't cross along investing alongside others?
Yeah, so we're fairly lazy, so we try not to lead. That's a good position for us. We'd like to get professional investors on board, people like Rob, who say, we'll set the terms because we have a pure financial return. And if we can get the same price as they are, that's pretty good for us. And they can do all the hard negotiating. And we're happy to come in. That's where we'd like to be. There are a few other things, right? Our Visa's money comes with strings attached. We're looking to do more than just cash. We are looking for partnership. And sometimes, depending on exactly who the opportunity is and the target we're working with, those strings sometimes mean that it's just not tenable, right? They're not willing to work within the restrictions of what we're asking for as an investor. And there's a lot of people who it's just a good idea to not take Visa's money because we will ask too much of your business and you're better off going elsewhere. And we try to be fairly open on that.
Fantastic. And other than Solaris, are you able to mention some of the other deals you've been involved with?
Yeah, I can't personally take the credit for the track record, right? But it's pretty good. Square, Stripe, Klarna, DocuSign, Marqeta. Yeah. So 4 out of 6 are billion-dollar companies, which is quite good.
Phenomenal. That's wonderful. And by the way, do raise questions to the panelists as well through the app, and I'll get to those after we've done a kind of an initial run-through of the panelists. Catherine, I know BBI are looking to increasingly focus on patient capital and the role that can play in supporting innovative companies in the future. I wonder if you could just explain to us a little bit about what does patient capital actually mean, and what impact will that have for BBI?
Yes, very good question. Patient capital, for all intents and purposes, means long-term equity capital into innovative businesses. So the patient capital program that we're going to launch in the next financial year, which is not very long away now, will be a continuation of the commercial VC Catalyst program that we have, where we invest in VC funds. But the gap that the patient capital review identified last year was that actually the UK has been very good at supporting seed rounds and startups. But when you need a big chunk of capital at a certain stage to really scale, there are very, very few players in Europe or in the UK specifically that you can go to that can write those checks. So we're trying to facilitate that part of the market by investing in VC funds that would have larger scale, that could lend on or could invest on in larger check sizes to underlying businesses. We're also looking to attract in institutional investors that haven't been active in that part of the market hitherto. So we all know about the pension fund community in the UK. They're consolidating. It's becoming more difficult for them potentially to invest in smaller chunks, in smaller funds. So we're hoping that we can bring some vehicles to market that would allow them to invest in this asset class and in this space.
Fantastic. And I know BBI specialises in alternative investments. What exactly does that sort of term encompass?
Yes, so hitherto, actually, equity investment or investment in VC funds has been the smallest part of the balance sheet. Most of what we've done has been investing in debt-related products. So we were an early supporter of Funding Circle, for instance. We've invested with a number of other platforms where we provide wholesale capital across their platform, allowing them to lend on to SMEs across the UK. We also invest in challenger banks, so typically by subscribing to Tier 2 capital, regulatory capital, where we can invest alongside other investors, or we could also take a piece on a unilateral basis. We support asset finance providers, and we also invest in debt funds. And we started actually in the mid-cap space, but as a lot of private capital has come back into that part of the market, coming back from the financial crisis, we've refocused our efforts on smaller funds, investing in companies with revenues of up to 100 million. So again, we're trying to pinpoint those areas of the market where we can have most impact and where we can have a catalytic event and effect.
Fantastic. And Anthony mentioned earlier the idea of a kind of strategic return over and above a financial return, by contrast to a traditional sponsors focus on financial return. Do you kind of have that same equation that you kind of compute on your
Absolutely.
deals?
So we have a double bottom line. So we need to produce a commercial return. We have an annual benchmark that we have to meet, which we've thankfully met in our first 3 years of operation. But we also have our strategic initiatives as well and objectives. So for us, for an investment to be successful, it has to produce a commercial return and hit those strategic buttons.
Super, thank you very much. Now Christian, at LendInvest, you've got a traditional VC backer on board backing the business on the equity side.
Yep.
You've also raised a lot of debt for the business as well to fund growth of the lending product. What are the key considerations from a fintech company's point of view in kind of raising those elements of capital?
Yeah, sure. So on the equity side, I guess for us as a business, we've been going for 10 years now, and I think it was we're probably going for about 5 years until we first heard the term bootstrapping and realised that just means you haven't raised equity capital yet. But we have raised equity capital eventually from a VC group called Atomico, and they've been hugely helpful. But in many respects, I think the organic growth in the early days actually really allowed us to build the foundation for a very scalable business, but to grow it in a sort of, to build the platform and the foundation for scale. But as a lending business, obviously, lending capital is kind of the lifeblood of our business. So for us, the key strategy there is to try and have as diversified a funding base as possible. And that includes both diversity of the types of investors we can bring into our lending through to geographical spread and so on. So when we first set up, we were essentially a funds management business and got some momentum and built a track record. And then once we had a track record as a lending business, it sort of allowed us to move into the institutional world. So I had funding from banks like Macquarie Bank and Citibank and so on. And we have an online investment platform, so investors can go online, select their loans that they want to invest in. And finally, we have a retail bond, which we listed on the London Stock Exchange, which gives retail investors the opportunity to go online, go to their stockbroker and invest in our loans. So I think it's as wide a funding base as is possible to ultimately build resilience around the business, but also to drive down our cost of capital. So for us, the cheaper our capital, the better the sort of products we can provide on the borrower side, and obviously the more we can scale our business.
Super. So as wide a capital base as possible. So that means crowdfunding or an ICO even in terms of the potential kind of more adventurous.
I would love to do an
areas?
ICO,
Okay.
but I don't think our investors would love that. Maybe in another lifetime, an ICO. I think that stuff is definitely fascinating, and there's a place for it. Probably not for our business. On the crowdfunding side, I'd love to do a crowdfunding round actually for our business. I feel like, particularly if it can be done with a customer loyalty type focus. I mean, we have over 20,000 investors on our platform, and so we have a ready sort of fan base that we can tap into. They're often asking us if they can invest. So I think that's quite interesting, and Revolut and some of those other sort of fintech businesses have been hugely successful in the crowdfunding raises that they've done. It feels like there's a bit of a negative perception around crowdfunding sometimes, but yeah, for me, I'd be up for it if we get the time to do it.
You could do it right. Okay, fantastic. And lastly, I guess your business really is around kind of trying to disrupt the mortgage market, or very successfully disrupting the market, frankly, and in a way, kind of competing with those banks that you mentioned earlier as funding partners. So how do you manage those relationships with banks? And do banks sometimes kind of refrain from lending to LendInvest because they see you as a threat, or do they just see that opportunity? And how does that equation work?
I think, I'd love to sit here and say the banks are scared of us. I think the reality is we're probably not at that scale yet. We hope to do sort of £1 billion of lending this year. In the scope of the UK mortgage market, that's a pretty small market share. But the reality is, I think the banks that we deal with see us as an opportunity, actually. So, they have an appetite, they're looking for a return, and they have capital to deploy. And so I think the platform we've built allows them to deploy their capital in a way that sort of using technology and data and all the rest of it is quite interesting for them. And I think generally with FinTech and certainly with lending businesses like certainly the mortgage market, it's £280 billion a year in the UK alone. I don't think we're going to see an Uber of mortgages. Certainly, we will be it if there is one, but I think the reality is, the regulator doesn't want a winner-take-all in that sort of market. So I think banks and FinTechs collaborate and sort of work with each other quite well. That's been our experience.
Fantastic. Thank you very much. And turning to Rob, we heard those really impressive stats earlier on the VC industry and the kind of track record of businesses funded last year. I'd love to ask you, though, about the kind of changing shape of the investment industry globally. In particular, we've seen kind of some pretty mega funds, frankly, entering the market globally. We've seen those new forms of capital raising we talked about earlier, particularly the kind of ICOs. And do you think, therefore, that the role of the VC needs to evolve in light of all of that, or how do you see the market moving on in the next few years?
So I'm obviously a believer in the VC model, and I believe having an investor who will invest early on in the business, be willing to take a lot of risk, and be very supportive for the business is a really important role and will continue to be a role. At the same time, we have to keep evolving. I think venture as an industry has changed hugely in the 8 years I've been doing it. In terms of the expectation of entrepreneurs, the professionalism of the venture community, the professionalism of the entrepreneurs, it really sort of keeps pushing you to up your game. I think part of that for us is understanding what are the other forms of financing that are out there. So we invested a few years ago in Crowdcube, which is a leading crowdfunding platform in the UK, I think also in Europe, funded £130 million into small businesses across the UK last year. And that's because we believe that model will continue to grow. I think as Christian mentioned, it's that social amplification. There are 110,000 individual investments made on Crowdcube last year. So that having this sort of, you bring your community as Brewdog beers to Crowdcube, they give you back their community, and you're raising money alongside of that. That's a fantastic option to have in your arsenal. I think it should probably come after you raise venture capital money or sort of professional money of some kind. ICOs obviously dwarfed that last year. It was $3 billion of ICO funding last year. I think part of that should not have been raised. Part of it absolutely should have been raised, and there is a fascinating technology being built here around a sort of decentralized landscape, which could replace part of our technology stack and also some significant sort of financial intermediaries. And so my big push over the last 6 months and for the rest of this year is really trying to understand that in enough depth to understand where is the real substance versus where is the hype. I think this year we'll see much smaller ICO funding, but into better companies in much more sensible structures.
Oh, and when you look at the debt market, Rob, you see increasing amounts of debt finance available across a number of different forms, continued growth of the venture debt industry as well. Do you tend to view that form of capital as a collaborator, or does that sometimes come into competition with you as a source of capital for growth
I think
of businesses?
debt is absolutely collaboration with us. I think what's been good over the last few years is seeing more flexible and more risk-taking debt. I think partly due to the search for yield everywhere, partly due to the success of LendInvest and some of the other marketplace lenders. That's woken up the debt market opportunities. And as the big platforms like Funding Circle and LendInvest, Zopa, start to push down the yields that they're giving their investors, those investors start looking earlier and higher risk to look for the high yields that they actually need to get to justify their existence as an alternative debt supplier. So we're seeing these guys coming really far down in the stack, and you're seeing companies that have raised a couple of million of equity and are in their first year of operation raising 10 million, 20 million debt lines, which is good to see in terms of funding innovation. Remains, I think, and on average, as long as you have a diverse portfolio across that, it should be a good performing asset class.
Fantastic, thank you. And Torre, you're often investing much earlier than Rob in terms of the stage of businesses that you're focusing on. When you talk to CEOs of those early stage businesses, do you find they typically know what the kind of the right forms of capital are to support them on that particular stage of growth, or is that an area where kind of more education and more development's needed?
Look, I think it depends. If you're a first-time or a second or third-time founder, I think for some of the younger / first-time founders, there's definitely an education piece around what some standard terms mean. I'd highly recommend that founders work with lawyers who are familiar with VC so they know what terms of market, which are not, what's worth fighting about. And kind of more than the terms that are in the term sheet, really reference who your investors are. Tom said that you chose your investor like your spouse. It is much easier to get divorced than it is to kick someone off your cap table. And minority shareholder protections in this country are among the strongest in the world. It's a very good thing, but let's be very clear that you're going to be stuck with your investor forever. So, we as LocalGlobe constantly offer to founders to talk to anyone in our portfolio, whether it's gone well, it's gone badly, have a reference. And I'm continually staggered at how few people take us up on it. I'd like to think it's because our reputation is so stellar, but I think a lot of people just want to get the cash in the bank. And if you leave away with one thing from this panel, and you're one of those people who was thinking about raising money this year, is absolutely take references on your investors, and if they don't provide them, they're the wrong people to be working with.
Fantastic, thank you. And as a VC looking at seed stage investment rounds, I guess you often come kind of into contact with angels and other forms of kind of crowdfunding and other forms of early stage capital. How as a VC do you find yourself looking differently at those deals than those other types of investors? So
we love angels. They're our biggest source of deal flow. The angels in our network, and they're great. And for us as a firm, it's a terrific source of differentiated and proprietary deal flow. So we think they're terrific. And EIS and SEIS, I think, have been huge contributors to the ecosystem in the UK and the richness of it. It's slightly less relevant for FinTech, but not always. Crowdfunding, we tend to see less of. It's usually around after hours, particularly because you do need an established customer base, like these guys have described, for it to work well, because when I have seen it work best in the past is when there's a consumer proposition and you have devoted customers who want to participate in your round, and that's usually the businesses we invest in a little bit too early to do that.
Super. I'd love to ask you a question from the audience as well, and do please submit your questions because we'll get through as many of them as possible. On the topic of the kind of valuation of startups and early stage businesses in the UK at the minute, and can you give us a bit of an insight on how you view those valuation trends and how that makes you think of kind of return and exit multiples that might be achievable in that environment?
Yeah. So it's kind of conflicting answer. On the one hand, the kind of savviest founders know that it's for VCs, it's all about ownership and not about the valuation at which they get in. But, they have, if let's say you invest at seed and you own kind of 10% of the business and you're going to get squeezed at each subsequent round. Let's say that at the time of exit, you now own 5% of the business. The business has to be correspondingly bigger to be a meaningful exit to you. So you're slightly less focused on price as you are on achieving the ownership that you need. But of course, everyone has fund restrictions, so it has to be for a reasonable check size. But that's why part of the reason I think that as the ecosystem matures and the founders get savvier, that those valuations are moving north. That said, valuations certainly at my stage are just a complete fiction. I mean, there's nothing there to value. What we do with the companies is say, look, what is an 18-month runway for you? And how much do you need to be well capitalized to build that 18-month runway? And then let's work backwards to a dilution that feels fair. And that derives a valuation on the company, but we're not saying there's anything intrinsic about that number. So, there are no revenue multiples, you can't say you can't give a price per customer, it just doesn't work. So, complete fiction. And so we just want to make sure that you're well capitalized for that 18 months before we can kind of go knocking on Rob's door.
Christian, I'd love to get a founder's perspective on valuation.
Yeah, sure. So if it's my business, obviously I have a different view to probably what I'll express now, but higher the better. But no, I think in some respects, I think the whole sort of cult of the unicorn is probably not that helpful in many respects. I think it's useful to get people excited about valuations and creating businesses that are worth huge amounts of money. But I do think in many instances that sort of valuation is manufactured, and this kind of what people don't understand often is there's sort of cap table preferences and all sorts of deals going on in the background, so that so you've got this high headline valuation that people are excited about, but the reality is, if you take that to public markets, you won't get anything like that. And so arguably that's my view in some instances. So I think that is something that we have to work through, and that's kind of part of perhaps the industry maturing to some extent. But at the same time, it's useful to get people excited and all the rest of it. But I mean, like in our business, we give all of our staff equity in the business, and I think that's a huge part of sort of motivating people to work towards a liquidity event. But I would feel very disingenuous if I was giving equity to staff on a ridiculous valuation that I knew wasn't real world sort of public market valuation for the business. So I think there's kind of a conflict, that it's something that the market has to work through a little bit.
Anthony, I wonder if you could comment on the kind of topic of valuation, and have you seen that kind of prevent you doing deals that you see real strategic value in, but the financials just simply don't stack up, or has that not been a feature?
So it's something we've walked away from a few times, right? I think as a strategic investor with that double bottom line, the two ways we're going to make profit on the deal have to kind of add up and be kind of equitable, right? So there is making a pure financial return, and it may be possible to do that, but if the order of magnitude of that financial return is kind of 10x the strategic value we're going to derive, that's not a good opportunity for Visa to pursue, right? We should at least get to equity, or have preferably the strategic value we're going to deliver is much higher than the investment we're going to make and return on investment. So yeah, we've walked away from deals where they were pushing a price which way outstripped the strategic value we're going to get. And if we were a pure financial investor, we'd still do the deal because they're good companies doing good work. But for us as a strategic, we just couldn't deal with that.
Is that kind of getting better or worse, or sound like an optician?
I think it's 50-50 for us, right? I think we're still fairly bespoke as an investor, right? Each deal is we have to analyze on its own merits, and it's sector specific. I think To the point of the startups on this cult of a unicorn, right? Everybody comes in and says, the valuation I have today is because in X years I'll be worth $1 billion based on this public market price to earnings or price to revenue ratio. And you're like, great. But what's my confidence you're going to follow that 5 years or deliver that in 7 years, right? And that's the risk of doing it. I think that still drives valuations higher, and the number you always get on day one is always much higher than the number you get on the day you sign. It's just how much lower can you push it, which is why I rely on people like Rob. We can be friendly as a strategic.
What we've seen a bit over the last few years is this discounting of risk. If we're investing early stage and you believe a company will be a public company one day, then the valuation is somewhat irrelevant. But it's how much risk is associated with that and how much you're willing to discount that risk. And you see SoftBank setting up a $100 billion vision fund in the UK and investing 100 million minimum check size, often 500 million. They are putting a huge discount on the risk. They believe these companies are going to be the global winners in what they do, partly because they have 100 million or 500 million sat in their bank account, which helps them really take the lead in winner-takes-all markets. That's why Masayoshi-san is willing to really discount the risk there.
Do you think that discounts the risk for you as an investor? Because there's those sorts of investors that can come in later.
I wouldn't want to rely on it because it's quite a new phenomenon and it's a very small set of investors. And I think when we invested in Revolut, we had the intention with Revolut it's going to be a sort of classic VC-funded business where it proves, raises. You look at the funding for N26 today, and I think there's more of that kind of funding kind of looking at the sector right now. I think there will be a lot more money thrown into that sector, but that wasn't the original plan. But if there's a similar dilution for 5 times as much money, as you know, it's hard to turn that down.
Rob, I think in the kind of earlier days of FinTech, if that makes any sense, I certainly encountered a lot of skepticism from traditional parts of the industry around the ability of businesses to sustain many years of sort of non-profitable operation as they grew the customer base and grew their kind of international operations. And I think my experience is that we found the VC community to be much more patient, to come back to that earlier point, than certainly I'd ever expected in supporting those subsequent rounds. Do you see that phenomenon, and where does that end?
So I think
when does the patience run out?
And our funds are structured as a 12-year fund, and if there are good reasons to do so, we can ask for extensions to that fund as well, so we can go on beyond 12 years. Obviously, IRR, internal rate of return, matters to us, and so we're going to be pretty selective in how we do that. But where we see a really strong asset that just takes time to reach liquidity, we're willing to be very patient around that. So as an example, we're investors in Wonga, which we invested in 10 years ago, perhaps, maybe 11 years ago, which obviously grew incredibly fast, then had to reset, rebuild the company from scratch, is now growing strongly again. And so, we'll end up being a very long-term investor on Wonga. We still believe there is an underserved market in the UK for that kind of lending, but they have to do it in the right way and continue building the business in the right way.
Super. Catherine, a question from the audience, which is around possibly a little bit left field, but do you believe ICOs could be a part of the solution to solving the patient capital problem? And I guess perhaps the question's hinting at, is there different types of instruments that can be useful or that we could use to support a more sustainable form of capital? So what's your view on kind of tokens or ICOs, or what other investment structures do we really need to kind of help support a more patient view of capital?
Yeah, so we're really interested in looking at alternative and new alternatives to what's already out there. So it's about matching the type of funding that particular business needs with the range of options that they can access. So anything that adds to that system we think is valuable, and everything has its place. And in terms of patient capital, we know, of course, that when we're investing in VC funds, they're going to have a 10-year life or a 12-year life. I think what we're trying to help create is more of a patient system, so that when that company has outgrown that particular venture round or venture fund, that there's somewhere else that they can go and get that next natural funding check from another provider. And it certainly can be part of that infrastructure, absolutely.
Super. And I kind of hate to do this at this stage, but it's raised by one of the audience members, and therefore, why not? The topic of Brexit, and what does that really mean for the kind of UK funding landscape, and perhaps just to broaden it a little bit, what does it mean for your perspectives on opportunities across Europe and the need to kind of shift to a more of a kind of genuinely kind of European focus? I wonder if, Tara, we could start with you and then work this way across the panel.
So the trouble with answering that question is no one has any idea what Brexit's actually going to look like. So with that caveat, I would say two things. One is that at seed stage, we invest in companies that are UK-based but that have global ambitions. And we like to co-invest with funds in other geographies who can bring local expertise and help when those companies are expanding. And I think those relationships will be more important than ever. But look, the truth is I don't know, and I don't think anyone knows. Although I'm kind of feeling more positive today, having sat in one of the earlier Brexit talks than I have done for a little while.
Rob, you have a view?
It's hard to see it as a positive in any way. I think passporting is really important for fintech business in particular, and I think digital harmonization across the EU is certainly beneficial for UK companies. For us, we're ambivalent because we invest across Europe, and there is plenty of talent across Europe, and we'll continue investing in UK, we'll continue investing in the continent. So no immediate impact. Perhaps the positive is that I think the startups will be always better placed to adapt to any changing landscape than a large company is. And so we're confident our companies can adapt quickly for this once we actually find out what it is.
It's a great last question for last session.
End on a high.
Day.
Brexit,
Yeah.
So, I mean,
transition
for
to
us, we're a UK lender. I mean, we obviously have a lot of international investors in what we do. But for us, I mean, I just kind of, not being disrespectful, but kind of sick of talking about Brexit. I mean, as an entrepreneur, am I going to hire less people or slow down or just pack up our business? Like, no, we're just going to get on with it. And that's the entrepreneurial spirit. You kind of get on with it and you deal with it. I kind of feel like, you know, I know it's bad and it's hard to see any positives in it, but from our perspective, it's kind of just, it's harder to hire people and all that sort of stuff. But if it wasn't that, it could be something else. I think something like Jeremy Corbyn would be way worse. But anyway.
Well, Christian, I think
Is this being recorded?
Yeah, I might regret saying that.
Yeah.
on that basis, I think you've killed Brexit for us. So let's kill Brexit. And just to wrap up, then I guess really, you know, what are the panel most excited about for the next 12 months? We saw those tremendous numbers from Innovate Finance again at the start of the session. But Anthony, you know, what really, what do you think what's the next big thing?
So for Visa, it's just the open banking world, right? Like half of the startups in this room are in open banking will pitch me and tell we're going to kill Visa, we're taking over, right? You're out of the way, we can disintermediate you. That's quite a fun conversation. We get to play in that space, right? So I get the joy of being at Visa, the person who gets to say, what does the future look like in open banking and what are the counterfactual bets that Visa gets to make? So I get to be part of that conversation. Actually, yes, if we were going to look at alternative models for Visa, what does it look like in the future and where should we put capital to work to make some of them come true?
Super. Any advance on open banking? Is that kind of seems pretty exciting to me.
Yeah,
That
it
I'm
is.
slightly
And-
biased view.
And all the data businesses that are going to be built on top of it.
Open
Banking,
insurance.
data.
Open insurance.
Okay.
It'll be coming.
Yeah.
Give it a couple of years.
Super. Well, I think, you know, can't wait to see, you know, what emerges next because it's such a dynamic space and such an interesting funding landscape. We're kind of out of time. Thank you so much for submitting the questions and thank you to the panel. So thank you very much.